What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are finally looking at real estate again. I know it's been a long time since I did a video specifically on real estate and what the outlook is going to be on this channel, and so we're diving back in and we're going to look at the three main factors that are going to be driving the real estate market. Specifically, residential real estate is what we're going to be talking about, not so much commercial real estate today. And so we're going to look at the three main factors that are going to be driving that and whether that's going to make the real estate markets continue to boom like they have been booming, whether it's going to cause a drop, whether we're at a crash, whether this is a bubble that's unsustainable. We're going to look at all those things right now. Ready? Let's dive in. All right, guys, so there are going to be three main factors that are going to influence real estate during 2021 and likely even past 2021, but we're specifically looking at this year. I want to also say a lot of times things take a lot longer to happen than you typically expect. And so this first one that we're looking at is going to be interest rates. And interest rates are going to be the number one driver of the housing market this year. And so what we're about to talk about with my expectations on what interest rates will do and the impact that they're going to have on the real estate market, I do expect that this will play out throughout this year, but it might take a little bit longer. It might bleed over into next year. But interest rates are going to be the dominating factor for the real estate market, just like they're the dominating factor in a lot of other things like gold and the stock market, bonds, pretty much anything that relies on interest rates, which, real estate is predominantly driven by how much it costs to buy it, which is driven by the cost of servicing that debt, right? And so the first thing you have to understand with this is that mortgages, we have to look at them just like we look at the bond market, right? We were looking at treasuries in a couple other videos and looked at the relationship between interest rates and treasuries, how the cost of the actual bond will go up when the interest rate for it goes down. They're an inverse relationship, and same thing with mortgages. If the cost of a mortgage goes up, that's driving the interest rate down. And so when you have a mortgage that is created, you're not going to have that bank keep the mortgage. That's why if you've ever bought a home or you've bought a rental property, pretty soon after you buy it, you go in and you go to make your first payment or your second payment, and you realize, oh, I don't, this company doesn't hold my mortgage anymore. I can't pay them anymore. They sold my mortgage to somebody else, right? And so then you have to create a new online, login and set up a new auto pay with whoever bought that mortgage to accept those payments. So it's just like bonds. It's debt. This debt is being created and then it's being sold on the market to whoever wants to collect those interest payments for the next 30 years. Now, as a borrower, you're going to look for the lowest interest rate available, right? And so you're going to go get a loan from somebody for the lowest interest rate you can possibly get, and then that bank is going to sell that mortgage to somebody else after that 30-year mortgage has been created. Now, take a step back from the real estate market for a second. We're going to look at the Federal Reserve. The Federal Reserve predominantly buys two things that go on its own balance sheet. Yes, they buy a lot of other stuff through the special purpose vehicles held at the Treasury. We're not looking at that. We're looking at what do they actually put on their balance sheet? What do they directly purchase to put onto their balance sheet? And since what they're purchasing is debt, they're technically lending. They're not purchasing. That's just the mechanics of how things work. But so they're purchasing assets that are technically debt assets that they're going onto their balance sheet. It's two things. It's government debt, like treasuries, and it is mortgage-backed securities. So when you take out a mortgage, it gets sold to somebody else, it gets packaged up with a bunch of other mortgages, and then that package, a lot of them end up on the balance sheet of the Federal Reserve. The Federal Reserve is directly printing dollars to purchase these mortgage-backed securities, which is really just they're lending. They're basically the facilitator of the lending that's going into the mortgage and real estate market. That's where all that money comes from. It's the ultimate source of where all of that money comes from because they're printing that money, they're lending it out into the market by buying those mortgage-backed securities. That goes as reserves on banks' balance sheets, which for every $1 in reserves that a bank has, they can create new money into the economy by lending out, a multiple of that beyond their reserves. And primarily that's being done through mortgages because they know that there's, somebody who will buy those with printed money. There's always going to be some sort of a market for those. And so for a bank to lend for mortgages, it's a very safe bet. It's the same reason why banks buy treasuries, because banks will buy treasuries, which means that they're lending money to the United States government, but the banks will then just turn around and they'll just sell those treasuries to the Fed because they know that there's a buyer of these treasuries, so it's a safe bet to make, and they give those treasuries then to the Fed. The Fed then credits the bank with their reserves, and they can go out and do more things now with their cash. They've got a certain amount in reserves again, and they don't have the assets on their balance sheet anymore. Now they can go out and they can keep on doing business. This is one of the reasons why the Federal Reserve has escalated their purchases of these assets over the last year, especially in 2020, because they wanted to make sure the economy kept on rolling along. Because if they stop their purchases, well, nobody else is going to do this lending because everybody's like, hey, everything's tight right now. Everything's scary. I don't know what's going to happen to the economy. So the flow of money crunches and slows down and really seizes up. And so since the entire economy so loaded up with debt, just by any historic measures, it is so loaded up with debt, when lending freezes like that, basically the economy grinds to a halt, because the only way that corporations or governments can continue to move forward is to pay off their old debt and pay their current expenses. But if you need new debt to pay off your old debt and your expenses, but nobody's lending, everything grinds to a halt, and then there's a deflationary death spiral, right? And so the Federal Reserve steps in and says, hey, we're going to blow up our balance sheet. We're going to buy as much debt as we can to make sure that we are the lender of last resort, basically, that new money is getting pumped into the economy through debt as much as we can, as much as possible, to make sure that the economy doesn't seize up and, kind of grind to a halt here. Never mind the fact that a lot of the stuff that would actually die is the froth, it's the malinvestment, the misallocation of resources. We're not really discussing that today. We're just discussing the mechanics of why the Federal Reserve wants to make sure that they're pumping new money in for debt expansion into the economy to make sure it keeps rolling. Okay, so now we understand that the source of the money coming in to keep interest rates down is through the Federal Reserve's asset purchases, primarily treasuries and mortgage-backed securities. The problem here is inflation. Now, the CPI has been relatively low for a long time now, but as things kick back into gear, as we're going to see a massive amount of fiscal spending, this, fiscal is through the government, monetary policy is through the Federal Reserve. So monetary policy is interest rate adjustments and asset purchases by the Federal Reserve. Fiscal policy is going to be things done by Congress and spending, and it's not just lending powers, it's spending powers. And so that's, things like taxes and tax credits and tax deductions, and then just actual spending for infrastructure or UBI or welfare or whatever it is. And so we're bracing for impact for an explosion in fiscal response for 2021. And so the what's left of the free market is looking at this and they're thinking, hey, when we see this much spending, usually what happens is all that money rushes in, but money doesn't just sit there, it's going to buy stuff. Well, if you have the same amount of stuff, maybe later on new stuff will get built. But right now we've got the same amount of stuff. And if everybody's money doubles, well, pretty soon that's going to bid up the prices, just like in a game of Monopoly. If the banker decides to double everybody's money, well, I'm not going to sell my property for what it's listed at on the board, because I know you could have afforded it before the banker doubled our money. And so now I'm going to maybe do an auction and see who wants to get it. And there's more money on the table now. And so that auction is going to get up to a higher price. And so I'll be able to sell my property for a higher price. Well, ultimately then people can afford more houses and hotels. And so ultimately what that ends up doing to the Monopoly board is it just makes prices of everything, of rents and property values, just go up when the money supply increases, because there's the same amount of stuff, same amount of properties on the board. That didn't change, just the money going after the same amount of things. And so same thing happens in the economy. When you dump a ton of money into an economy, it goes and it buys stuff. It's going to buy assets, it's going to buy houses, it's going to buy goods and services, it's going to buy cars, whatever it is, and that's going to push prices up. And so the what's left of the free market is looking at this and they're saying, hey, if prices are going to go up next year, things are going to cost me more than they cost me right now. That means that if I lend you $1 and you give me $1 back next year, I won't be able to buy $1 worth of stuff of that. Maybe I can go out to dinner for $100 right now. Next year, it'll cost me $120. Let's say. And so if I'm going to lend you money, I want to make sure that the interest you're paying me is going to compensate me for what, the rise in the cost of living, the rise in the cost of the general level of prices. Now, usually what people are just looking at is the CPI, which is going to understate it, but there's most people in the market, investors, banks, corporations, they're looking at the CPI. But they're also looking at expectations, because CPI is like current, right? And so they're looking at expectations of what the CPI will be in a year, things like that. And so So as you see the free market start to recognize all of this fiscal spending, you're seeing inflation expectations start to rise. People are bracing for impact for costs of everything to start to go up. Well, what do you think that does then to the debt and to interest rates? It's going to make interest rates go up, because if a bank is going to lend you money for 30 years, again, they're going to want to make sure that the money that you're paying them back is worth at least as much as the money that they lent you in the first place, let alone kind of trying to consider any profits. And so recently, and I'm talking very recently, within the last couple of weeks, mortgage rates have started to spike. Just the same as interest rates on things like treasuries have started to go up, because anybody who's a lender that's left in the free market is saying, I don't want to lend unless I can get a higher interest rate, because my expectations are that inflation is going to be higher than it looks like it is right now. So mortgage rates and others are starting to spike. Now, this will put a damper on the real estate market. This is going to cause, a lot of the growth over 2020 in the real estate prices across the nation were driven by mortgage rates being at, a historic low, right? Everybody's refinancing. Anybody who can is buying because they're trying to lock in these low rates. And so that was a dominating factor in the real estate market throughout 2020. That will probably halt, or maybe not halt, but it will probably slow down, because we're going to start to see a spike in interest rates. Now, here's the problem. A spike in interest rates from the free market kind of stepping out and saying, we're not lending unless we can lend at a higher interest rate. That's going to cause what I was talking about at the beginning, where you start to see the economy grinding to a halt again, because the entire economy and the government is too over leveraged. They have to use new debt to pay off their old debt and their current expenses. This is true of the economy as well as the government. And so what this is going to prompt is probably some sort of a flash crash, or some sort of a spike in the repo market, or some it's going to burst forth in an unexpected area, something like that. And it's going to be a warning sign to the Federal Reserve. And what they're going to do then is realize, hey, all of this manipulation from before, keeping interest rates low, the free market's kind of responding and trying to adjust to inflation expectations. We have to step in here, because now it's kind of bursting in another area. It's kind of like the whack-a-mole game, right? Where you lock down one area and then the pressure bursts out another area. And so they're going to have to step in, and what they're likely going to do is institute yield curve control, which I've talked about before, but specifically with mortgages, they're probably going to have to completely take over the mortgage market, and they'll probably do that by just drastically increasing their mortgage-backed security purchases. They'll become the only, or predominantly the only, buyer of mortgages, so much so that it drives up the price of that mortgage debt, that keeps the interest rate on mortgages basically at, I would guess, probably 1%. They'll probably try and peg mortgages right around 1%. It might be higher, might be 2%, could be lower, could be 0, but I would guess that they're going to step in with full force to try and do something like pegging interest rates with mortgage rates at 1%, along with the rest of the yield curve, because they're going to have to step up and increase some of the action that they're taking in the credit markets to keep the longer term debt at low interest rates as well, by purchasing all that debt. So if we look at a timeline of this year, interest rates, the effect that interest rates will probably have on real estate this year is that interest rates are going to spike here. And we're going to see a spike in interest rates, which is going to massively slow down the real estate purchases. And so it's going to slow down the growth in the real estate market, slow down the appreciation of all of these houses. And it's going to kind of drive a big stop sign is going to come up, and people are going to stop buying, stop refinancing. And then once that bursts forth into some other areas, maybe it's delinquencies or foreclosures, or maybe something in the stock market or something in the credit market, something's going to happen. It's going to be another catalyst for the Federal Reserve to increase big action. They're going to step in with full yield curve control. It'll probably be sometime towards the end of this year, and it'll tank interest rates again, because they're just going to start purchasing all that debt really quickly, and they'll peg mortgage rates to, I would guess, something like 1%. That's going to start probably the last major epic rally in real estate here, where you're just going to see an explosion in prices, because literally by that point, inflation expectations will be so baked in that by pegging mortgage rates to something like 1 or even 2% means that everybody knows that for sure that they're actually getting a negative real interest rate, because everybody at that point will know for sure that inflation will be higher than that mortgage, and so it'll spark a frenzy of money pouring in to lock in these. Basically, you're getting paid to take out this debt. It's shorting the dollar, but you're getting locked in at an interest rate where your interest rate isn't costing you the same amount as what you're gaining to short something, which is like if you go and short a stock like Tesla, for instance, or if you short a stock that's in a big bubble, or you short a stock like for a long time it was like Sears, it was just going down and down and down and down. When you short a stock, a lot of times you'll have to pay an interest rate in order to borrow the shares to sell, because the rest of the market kind of agrees, hey, we think this is going down, and so in order to borrow shares to sell, because you don't own them, that's why it's shorting it, you're going to have to pay an interest rate on those shares. And so a lot of times the amount that the shares go down by is going to be about the same as the amount that you have to pay in interest. And so you're not going to make much, if anything. With mortgages, though, since the interest rate is going to be pegged and locked in order to keep the economy rolling and not let a deflationary death spiral and the economy grind to a halt, they're going to have to peg interest rates really low and not let the free market set the interest rates according to inflation expectations. What that's going to do is mean that mortgages and other interest rates are going to be, by definition, negative. So people get paid to take out the debt. This is why a lot of these very intelligent and very experienced real estate investors are now saying that debt is the asset. Debt is the asset because you're shorting the dollar and you're getting a negative interest rate in real terms when you account for inflation, and then the asset that you purchase with it, like the house, is kind of just the hedge. It's the collateral, but the real asset is actually the debt itself, because that's what's making you money. And so it looks like that's going to cause a massive amount of wealth to flood into these assets. And this is not something that's unique to history. Again, this is stuff that we've seen happen over and over again throughout history. When you look at how hyperinflationary sequences play out in countries around the world throughout the last 100, 200 years, this is really what you see when you see central banks trying to manipulate monetary policy and cause interest rates to stay low in order to achieve their objectives. Stuff breaks and then stuff leaks out, and they have to do more and more manipulation until all the real wealth flows into the hard assets and takes advantage of the fact that, hey, the Federal Reserve has to do this. The central bank has to do this. That means that there's free money sitting on the table, and it's not going to last forever. So there's going to be a ton of wealth that's basically borrowing money that's no longer going to exist at some point in the future. They're taking that to buy real assets that will exist in perpetuity, buying a house, buying gold, buying land, buying farms, whatever it is, buying stocks, equity in businesses. And they're basically getting that for free when you think of the future, in 10, 20, 30 years, because they're using dollars that won't exist anymore, or at least not in their current form. It'll be much easier to pay that off. Now, there are two other things that are going to contribute to real estate during 2021, and these are kind of obvious ones. And so I spent obviously the majority of this video talking about interest rates, because that's the one that I think is least understood, and most people have a lot of fear right now. And I think that fear will become well-founded when interest rates spike and real estate kind of grinds to a halt a little bit, and then it'll kind of be reversed when interest rates go back down. The other two factors are going to be inventory and demographic changes. And so we've seen inventory be extremely low, extremely tight, and that's been a big driver of real estate over 2020. During 2021, it's probably going to change. A lot of other people are going to say, hey, now I'm not afraid to move anymore. I'm not afraid to let people into my house anymore. You're going to see people trying to take advantage of, hey, I want to sell now to capitalize on these high prices, to maybe I'll rent for a while or move into something else and I don't have to have a mortgage anymore. Whatever the situation is, you're probably going to see an increase in inventory, which is going to put a damper on the price increases. It's going to go along with the pattern of the interest rates. And then I think when interest rates hit zero, we're going to have a buying frenzy. And so inventory is going to be back down, because ultimately everybody who sells their house also has to move in somewhere, right? For the most part. I mean, you're going to have some kids move back in with parents at home, but for the most part, everybody who sells a house is also a buyer of a house, or at least they're going to be a renter of a house. And so if you're buying homes for cash flow, like for real estate, if you're buying homes for cash flow, like rental properties, whether it's, single family, duplex, 3, 4 units, or up to your partner in an apartment building, it ultimately doesn't matter what the prices or the values of the properties do if you're investing for cash flow, because right now it's going to take at least a decade for new building to catch up to the current demand. And by demand, I mean the amount of people who need somewhere to live. And so just because a lot of houses are coming onto the market doesn't mean that all of those are going to be empty. Somebody, on aggregate, there's not enough units to supply the housing for all of the people that need to live somewhere. And so you're definitely going to see more inventory this year. I expect to see more inventory than we saw last year, just because you're going to have more selling. But that doesn't mean that that's going to directly have a negative impact on prices, simply because everybody still has to move somewhere. And even if they're renting, if you're investing for cash flow in rental properties, that's still good for you, because that means rental prices will continue to stay. And we're very far away, but just based on new developments, new projects, and new building, we're very far away from that inventory, the supply versus demand equation from switching. And then you say, okay, that's great, but there's actually places that people are leaving and there's way more supply than there is demand. And that's absolutely correct. That's the third point, the third thing that's driving real estate in 2021. It's demographic changes, right? So obviously you're going to have local areas. You're going to have places like San Francisco, New York City, and Chicago, and Seattle probably. You're going to have these areas where people are just leaving. And so, yes, demographics trumps everything, right? Doesn't matter what interest rates do. Doesn't matter what inventory is. I mean, inventory is going to be driven by demographics ultimately. And so when you have people just leaving an area, there's going to be a lot of houses for sale. There's going to be a lot of empty space. That's going to drive prices down, because if you don't drive your prices down, somebody else is. And so that's, competition, right? And so you're going to see demographics be a main driver in local areas. You're going to see other places like in Arizona and in Texas and in Florida. You're going to see some of these places just explode, right? Demand is going through the roof. People are flooding there from all over the country, right? And so demographics is going to be the number one driver. And ultimately, nationally, we're going to see some averages, and then you're going to see in local areas, man, this area is just collapsing, and man, this area is just booming, right? So it pays to know your area and know where you're investing and watch the demographics to see, are people moving here or are people leaving here? That data is all available online. Now, over the next 5, 10, 15 years, demographics will probably start affecting our country as a whole instead of being just isolated in little pockets. We might see a demographics change as it becomes harder and harder and harder for new people to come into America. Our birth rate is not like it should be if we wanted to have a self-sustaining population, or let alone actually growing our population. Most of our population growth comes from immigration. It's getting harder and harder to come in, and when as the government makes it harder and harder to leave, and makes it less and less attractive for new people to come here and more attractive for wealth to leave, you're going to probably see over the next 5, 10, 15 years, demographics really start to change, and you start to have the population start to shrink because more people are leaving than coming in, and the birth rate of everybody who's staying is not enough to support, let alone grow. But that's much further away, at least from what I expect. That's further away than just the next year. And so over the next year, I do expect we'll have a little bit of a slowdown through this first part of the year. There'll be some crisis, some catalyst, and interest rates will get pegged. Everything brought down across the board, yield curve control across the board from short term all the way to long term, 30-year. Mortgages will be included in that, and prices will just skyrocket from that. There will be a frenzy to get into assets, with basically getting paid to get free money, take it and use it to buy an asset that you'll keep even when the money that you used to get it becomes worthless. Now, if you're looking to get into real estate investing or buy another rental property, and let's say your local area, the demographics that we were talking about, it's very unlikely that you live in an area that is a very good area for rental properties. And so if that's the case, I really like Roofstock. They make it super easy for whether you're a first-time investor or you're an experienced real estate investor. If you're looking to buy out of state especially, they're a fantastic resource. They've got a lot of inventory on their website. They've got a very streamlined process, makes it really easy. They connect you with local vendors like property managers to make the whole process really smooth for you. And it's a platform built for investors. So a lot of the properties are actually already rented. They come with renters in them, leased for the next couple of months type of thing. And so if you're looking to get into real estate investing and you need a little bit of guiding or a little bit of assistance or finding a good property, they're a great resource. I've got them linked in the description below. As always, I really appreciate you guys. Thanks so much for watching. Have a great day.